Hi, I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. So after almost 2 weeks of being, it could have been 3 weeks at this point of not being around, we're back. I was in the UAE, so I was asked to go from, it was a joint venture between the U.S. Department of Commerce and the UAE because C6 was accepted into PACE. Now we're looking to try to get into COP28, so it was a nice move. Then we were in Calgary, so a lot of things happening, a lot of things moving, which are all positive. But now back to some of the grind when we look at doing the EIA show, the macroeconomic show. So it's interesting because some of the data, and we've been tracking it, unfortunately I wasn't able to film, but we were tracking it, and sometimes it's nice to take a step back and then look at how the data kind of unfolds without trying to give these predictions. And for those that have been watching us, you know, a lot of the things that have happened over the past couple weeks, especially this week, is exactly what we've been saying, where demand is going to struggle. You're going to see that, and again, it's going to rise, but it's just going to fall below what is normal. And there's still a decent amount of crude out there. Now, we did get wrong OPEC. You know, we didn't think that that OPEC was going to make a cut, but we did say that if there is something, it was going to be purely Saudi. And yes, there were some movements in terms of other adjustments, but it was more of bringing the quotas down to current production and less about a new cut when you look at Russia, Nigeria, Angola. And we're going to go through that in more detail. So the way that we're going to break it down is we want to look at the overview. You know, how are the energy markets setting up for summer? Looking at, okay, well, where have we been now when I was gone? You know, where are we now? And luckily, I won't toot my own horn, but I was pretty correct on the direction of gasoline and distillate. But we want to look at how is that going to continue. Then in the second segment, we want to look at how demand still remains a bit sluggish, but do we see any pickup? Is it going to stay kind of sideways? And for those that have been watching us, our view is that demand was going to get to kind of this point and then just go flat. And that's something that we still see happening. We want to look at what are the indicators giving us that confidence. And then the last segment, we're really going to break down the OPEC plus cuts. You know, because even as they cut, you had price increases from Saudi. Did other GCC nations go the same way? And what are they going to mean going forward? So a lot of things to cover, but after being gone, I think we have more than enough things to go over. So now looking at what are some of the things that have happened so far. So total oil and product stockpiles, you can see are just mirroring normal seasonal moves. You can see it's slightly above the average. But one of the things that we've been saying is that based on everything in the market, it is all looking to be very in line with where things have been previously. So total oil product stockpiles, you know, the surplus widened from 24.4 to 36.4, but again, the move up, you know, you can see there's normally that bump and then you kind of go sideways. And the sideways movement is the shift between crude in stockpiles versus product. Total crude, land and floating, the surplus widened from 24.1 to 26.6. But again, it's very normal. And typically we start to get to this peak. End of June, beginning of July is kind of that peak. And then you get those draws. So those draws turn into oil products. So here, total oil product stockpiles, the surplus widened from 0.3 to 9.8. And again, you can see that there's typically that pretty standard move. And as we've been saying, it's very gradual. There's nothing too crazy up or down, which is why we've said that, look, Saudi, well, let's pick on Saudi for a moment, but really OPEC, they're trying to target $75 Brent. That's the level they want. If you want to call it the OPEC put, go ahead. But there's always going to be a trading range. You know, you can't get away from that just because it is a market. There is those movements. And we've been saying 72, 73 is right around the floor where you'd likely be buying. And then at 78, you'd be selling with the idea that 75, 76 is kind of where we hold. Now, we've also been saying that we believe that the risk is to the downside, that you're going to have a bigger slowdown in demand. And again, it's just looking at the data, looking at industrial activity, looking at shipping, looking at ag, looking at the consumer. There's not a huge amount of surge that's coming. And typically, if you think about it, the summer is where you have the most activity. And we just don't see that coming around to the same degree. Will demand go up? Yes, it will. It's inherently going to happen. There's people are going to take vacations that haven't taken vacations. It's just you're not going to get to where we have been in the past. And from a gasoline perspective, we said it's going to be about, let's call it 400 to 500,000 barrels below normal. From a distillate perspective, we've been saying it's going to be 200 to 300,000 below normal. But then the other issue is the amount of gasoline that's just sitting in the market. And one of the things that we were saying is that we were going to get a very consistent import from Europe on the gasoline front into the East Coast, Pad 1, which has been happening, and it's going to stay strong. Now, the question is going to be a shift in physical crude, and we want to look at that in more detail in segment 3. So now when we look at total land storage, the deficit widened from 21.2 to 24.7. But one of the things that we were saying is that where typically there's a bit of an increase, we just expected it to go sideways. And here, when you look at the sideways move on land storage, you can see that the comps get a bit easier when you look at the average. And west of Suez, the deficit narrowed from 14.3 to 12.9. Again, very sideways move. With east of Suez storage, deficit widened from 6.8 to 11.8. But that's just Japan, not looking at China, which we'll talk about in more detail in segment 3. Total floating storage, the surplus narrowed from 31.6 to 22.6, but you can still see that it's still at the highs. And we're going to go through this in more detail, but you're seeing that level staying elevated, and it's because Russia's pushing as much crude into the market as they can. Iran is actually keeping a decent amount of crude in the market, and that is, again, flowing a lot of that into Asia, but that's, again, pushing out some of these normal purchases. So when you look at what has now happened, well, you've had Middle East storage increase, but you've also had West Africa storage come down because essentially those in Asia, because just to give you an idea of how Saudi sells crude and typical OPEC in general, they have term contracts where you nominate if you want how much of your term and then above, and then they'll allocate on who gets what. Well, you'll be surprised to know that not only are people not taking or asking for less than term, but they're obviously not taking excess, and then they're making up that difference from West Africa. So those are some of those key shifts that we continue to see. West of Suez, the deficit widened from 4.3 to 5.5. That is, again, that West African drop, which is going to stay at the lower end. But then on the other side, east of Suez, the surplus narrowed from 21.8 to 11.4. But we actually see that pivoting back up based on what we've seen. So west of Suez should stay a little bit tighter. East of Suez getting a bit looser, keeping the total floating storage fairly in line. Now, we did get a sizable crude stock build. The total was 7.92 million. That's just 1.4 million below the 5-year average, but 48.4 above the year over year. Pad 1, small draw. Pad 2, Cushing had sizable builds. They're now pretty much in line with the 5-year average, which, if you remember how far down Pad 2 was, this is where, like, when you looked at the 5-year average on the whole, you got that fill back, a lot of that coming from Pad 2. And as we've been saying, it was because of all the imports that were coming down from Canada, fairly slower demand, but now you're starting to get the stabilization. Cushing has built a bit faster than we were expecting. For those that have been watching, we said that Cushing was going to build, but it was going to be 200, 300,000 barrels at a time. While we were gone, there was some sizable builds, with another one being right here. And then Pad 3 had a big build of 6.13 million, taking us above the 5-year average. But remember, the shift is going to be imports versus exports, and exports are going to stay very strong, especially when you look at how Saudi has priced themselves out of the market in a significant amount of areas, including Europe and Asia, which is going to support light sweet crude coming from the U.S. and taking market share, or at least maintaining market share in those markets. West Coast, small build, 380,000. And then when you factor in the SPR, we had a total build of 6.04 million. Now, the difference between the two, for those that remember, we're still in the fiscal year of 2023 for the U.S. government. That again switches in July, where we go into fiscal year 2024. So we're at the tail end of the the SPR sales that were slated during the negotiations, if you remember, in 2013, 2014, signed into law in 2015, and this was already supposed to happen. And if you look at 2015, it was agreed upon that between 2023 through 2027, there were going to be SPR sales to help fix the system, to do all those different things. That obviously was pulled forward. They have canceled everything from fiscal year 2024, starting next month, through 27, 28. So we're all done. Essentially, all those SPR sales were pulled forward. Now there's talk about potentially buying more, but again, that's why you still see those draws. Crude oil production, 12.4 million barrels a day. Again, we're a little bit above that, but one of the things, and we talked about on the FSC show, our expectation was for an exit rate of 12.7 million barrels a day. But because the frac spread count has slowed in terms of that level, we think that there's some downward pressure to that estimate, and it could very well be something much closer to 12.5, 12.6, in that range. But it's really gonna come down to how active do the E&Ps get this summer, and so far things are a bit below our estimates, but that's going to be something to watch. Now, when we look at crude oil and inventory, one of the things that we had said was that things were looking similar to 2019. And when you kind of average it out, you can see the rate of change is fairly similar. I was starting from that May period in terms of the rises between 2019 and this year. Now, the question is going to be, are we going to get a big pivot and we're going to see draws on the crude side, or are we just going to go sideways a bit? And for us, one of the things that we continue to see is this very sideways move, where it's not going to be bullish or bearish. It's going to be fairly stagnant. And a lot of that is really, I don't want to say by design, but when you look at demand coming down and OPEC managing their levels, that's what you're seeing. And that's why when you look at the 70s, and we've been trying to relate it, we've been relating it back and forth to the 70s. In the 70s, even though you had multiple different recessions, you didn't get this huge drop in crude pricing because you had the embargoes. You had them managing this supply level, and that's what we're seeing today. You're seeing a management of the supply level, so you're not going to see this massive drop-off, which could spark demand. If anything, you're going to see something supporting stagflation and creating this struggle point. Now, when you look at commercial oil storage and products, you can see, again, we're kind of following those increases. Happened a little bit later, but as we've been saying, there's a lot of product out there, especially on the gasoline side, and we see more pressure on the exports, which we've been talking about in both gasoline and distillate. We were right in distillate, wrong so far in gasoline exports, but when we go through the differences, PADD 3 has a lot of gasoline, and they're trying to manage storage. So even though mathematically maybe they shouldn't be exporting, it's a matter of trying to balance that out. And by mathematically, I mean the arbitrage in terms of some of these different pieces. Now, not to say that it's not net positive, but it's not to the level that you would expect, to the point where you could actually see sales still happening even if it was closed. Crude oil in PADD 3, you can see is having a bit of a counter-seasonal bounce. Again, we think it'll continue to the downside, but you can see that it's now kind of back in line with these elevated levels, and we should start to see draws. If we see continuous builds, that's going to be, I think, a bigger concern, and will also support a bit of why Saudi did what they did. But there's going to be a lot of things to watch. Cushing continues to rise. You can see the pace of the increases has accelerated. We were liking this back to 2017, 2019, where you started to see those builds. Rate of change basis were right in line with those 2019 increases. And you can see that at this point in 2019, you kind of flatline and go sideways. Now, obviously, we're starting lower than we did in 2019, so it's not a one-for-one, but I'm just talking the rate of change, and then the sideways move is very likely at this point in time, especially given some of the pivots that we've seen on the demand front. And that's when we start looking at refinery run rates. So runs had a decline of 2.1%, went from 95.8 down to 93.7%. For those that have been following us, we've said that 96 was going to be the high. It got there a little bit sooner than we were expecting. We thought we were going to kind of bounce around between 92, 93, and then get that, kind of that peak of 95, 96 as we went into July. Happened a bit sooner, but then you had some things pull back. Now it's interesting because the refinery utilization fell 2.1% because operable crude oil distillation capacity rose nearly 240,000 barrels per day, and because gross throughput fell 160,000 barrels per day, even though crude oil input only fell 61,000 barrels per day. So you're starting to get a little bit of an adjustment in terms of the capacity coming online, kind of getting you to this point. So again, a lot of stability here. We will continue to see some of that that level. And here you can see we ran to the kind of the peak, and now we pulled back a bit, and we're back to where we have been in that cluster, which is 2019, 2022, right within those levels, and that's 2017, 2018. So it's not like we're right where we should be. The problem is, again, those run rates in terms of gross barrels versus the capacity, which is, or I should say, the rates that we've talked about. Imports came down slightly, 19,000 barrels a day. That's 859,000 below the 5-year average. Pad 1 had a sizable drop of 313. Pad 2, small drop of 113,000 barrels a day, still well above the 5-year, year over year. Again, it'll be lumpy, but for Pad 2, we're still going to stay at that top end of the cloud. Pad 3 had a big bump of 629,000 barrels a day, but that's still 478,000 below the 5-year average. And that's going to be the problem. We're just not going to see the same level of imports. And that's going to be supported, obviously, based on what the physical market is showing us. But it's still going to stay in the cloud. We're not going to make new lows, but it's just going to be below that 5-year. And then when you look at Pad 5, small drop of 100,000 barrels a day. But again, there's a lot of lumpiness. So we should see a reversal higher in Pad 1, 2, and 5, and a reversal lower in Pad 3, because remember, timing delays, all those fun things. But net, it's still going to keep us well below the 5-year. And here's what we were talking about with Pad 3. Having those seasonal moves, well below the 5-year average, but still, again, in that lower end of the cloud. Pad 2, had that nice bump coming down to that normalization. But again, still above the 5-year, still going to stay in the top end of the cloud. Don't see that changing. Implied demand, you had a small drop of 25,000 barrels a day in gasoline. Still stronger than the 5-year. But again, and we'll talk about this based on the chart in terms of some of that sideways move. And when you look at Gas Buddy and TomTom, it's actually a bit lower. So again, it's just some of that timing delay, because we do have Juneteenth coming up this Monday. And we do have, at least in New York and the Northeast, this week for some was the last week of school. Next week, some people have school Tuesday, Wednesday, and then we're out. Obviously, it's different when you look at the South, the West, that are already out of school. But again, that's why we're coming into that core demand cycle, which is July 4th to August 15th. Obviously it can move up and down depending on where the July 4th holiday falls, where the schools start up, but it's usually around those periods. So we're getting to the peak, and that's where we will see a little bit higher move, but we'll go through that more in segment 2. Now, when you look at it on the level, and we highlighted the average end 2023, because you can see we're right in line with that 10-year average, but the 10-year average is obviously skewed because of COVID. But you can see that we're having less of these swings, a bit more of this consistency, and there's still a little bit of this sideways move. We will get that nice bump, one more at least heading into Juneteenth, which is why we're still a little bit elevated. I think we do have one more down move in demand. And then we'll see that continuous grind as we go into July 4th. And the reason why we'll have that little down move is because TomTom and gas buddy are down here. EIA's a little bit higher. Typically they switch, and this will come down where the others are going to start to show those increases that we continue to expect as we go into next week. Day supply of for crude oil, very stable, not too much to say there. When you look at gasoline storage, 1992 to today, you can see again that strong bounce. On a rate of change basis, again, liking this back to 2019, our view is that it was going to follow 2019. We were a little early on that call. We continued to see some draws kind of baseline. And now you can see the rate of change is very similar to 2019 and today. And based on the arbitrage, it still makes a ton of sense to go from Europe to the East Coast. And that's going to pull in more product as demand remains a bit sluggish. But remember, you still have U.S. refiners that are getting more active. So U.S. refinery activity picks up. Imports remain elevated as demand kind of languishes. And not to say that it's going to be in the 8 million range. It's not. It's just we're coming into normal summer activity. Normal summer runs with a lot of that topper of additional imports, which again is going to keep us elevated. Distillates, as you can see, we typically have builds this time of year. Seasonally speaking, we should be increasing rate of change wise, very kind of stable, but it's going to be interesting to see if we maintain this rate of change, because if that's the case, then we'll see this increase a little bit faster. The question is going to be, can we get the heavier crude? And based on the crack spreads, it does support a little bit of an additional distillate creation, which again is going to put more product in storage. And then you look at kerosene at the elevated level. Again, that's flip between kerosene, distillate is going to be one to watch. Futures, we're still in slight contango. That we don't see that changing really in the near term, just given some of the pivots in terms of demand. We've had VLCC rates start to creep higher. So typically when that happens, it costs more to store offshore. So sometimes you'll see those prices again get pushed up to accommodate some of those additional price shifts. And then when you look at floating storage, picked its head up a little bit in the U.S., but still remains at the low end. And it's just going to be that timing delay between the two of them, which we don't see changing in the near term. So that's what we have for you in segment one. It's a little bit longer than normal just because, trying to give that color that we have. So if you have any questions, please let us know. And in the next segment, we're going to go into the U.S. and the U.S. demand cycle and where we see that going as we head into Juneteenth as well as July 4th.